Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. It feels really bad to record videos on days like this. I'm not even waiting for the market to close because I know that it won't make any difference. Everything is red, right? The Nasdaq is down 3.5% plus, the S&P nearly 3%, the Dow more than 2.5%. All the sectors are deep red. Even defensive sectors like consumer defensive and utilities. Really, the only sector that's hanging in there is energy, and that's largely due to the price fixing by OPEC plus. I don't even remember the last time I've seen the stock market map this red. It's just insane. Well, unfortunately, the boogeyman showed up and he crashed our stocks again. So let's get right into it. What the heck happened today? Well, Jay Powell showed up, gave a nothing burger speech. Really, he did not reveal anything new, to be honest. I watched the speech live, and all he said, all it took to crash the market, was Jay Powell saying that interest rates will remain higher for longer. Basically going against this idea that's been circling around the media that the Fed could pivot next year and cut rates really early next year, and that could provide some lift to stocks. That's an assumption. It wasn't based on anything really that was the bull thesis. It was just based on this singular assumption. And earlier today, before the market opened, we had a bunch of economic figures drop, right? We had PCE come in below expectations again. So that was a very nice signal for the bulls. We had disposable incomes holding up okay. Consumer spending was doing okay. Consumer sentiment improved significantly, and 5-year inflation expectations went down. So everything that you wanted to go for the bulls went for the bulls, except for Jay Powell. That's the only thing. Now, I am quite shocked by the extent of this sell-off. I did expect a sell-off, but I expected it to happen Monday, not today. Today, I was actually expecting one last push to the upside to fill this one final gap, trapping a lot of bulls, and then seeing something like this on Monday, not today. I did not expect this reaction by the market towards what the Fed said, towards what Jay Powell said, because to me, honestly, he did not say anything. He did not say anything new, really. He just repeated these same old things, right? The Fed is going to be resilient. We're going to continue to raise rates and hold rates higher for longer. We expect jobs to soften. The Fed has been saying all of these things for a while now. So I'm surprised that the market was surprised by this sell-off. I think the sell-off is probably a little bit overdone. Just look at this absolutely enormous red candle. The last time we had a red candle this large, let's see, not even in June, not even during that collapse. This candle is even larger than the May 18th sell-off. I could go all the way back to the 7th of March to find a candle that's anywhere as big as today's. It's just an insane sell-off, right? We had the weekly expected move come in at 413. We hit that weekly expected move on the first day of the week, and that did prompt bears to close their short positions. I was one of those people. I did close my position here, and I did play this bounce to the upside. I just expected more steam from this bounce. So what does this mean? What's going to happen now? Well, this sell-off is very extreme, and unfortunately, there is no real support for the market all the way down to $400, even all the way down to $390. Remember this pivot zone? I did talk about this pivot zone a lot because it acted as support, and once the market broke through it, it acted as very strong resistance. And once the market finally broke out of this resistance zone, it retested that zone before moving higher. So this is a very important pivotal zone, and very likely the market will not find any real support until we hit this zone. We might see some buying off the $400 level just because we have this 50-day moving average, as well as because $400 is a nice round number, so it's a psychological number. But other than that, really, it's not really that strong of a support level. No real support until $390. And we do not have any real economic events coming up until the 21st of September, when the next Fed meeting will take place. We do have some CPI data coming in early September, so that's going to be interesting to see what happens there. I mean, look at this; it just keeps on going, absolute insanity. Unfortunately, also this move to the downside means that a full measured move would take us down to, let's see, look at that, $400, perfect, on the dot. The way to extrapolate the full measured move, guys, is you take the top all the way to the bottom of the move, and then you move that to the top again of the bear flag. This is now a bear flag. All the way to the bottom would take us to $400. So very likely next week we will see $400 getting hit. We'll see if the market tries to bounce back up. Maybe touch 410 again, right? Maybe we see something like this: a bounce off 400, a retest of 410, a rejection, and another leg of selling. This is now the base case scenario, unfortunately, and this move does not benefit anybody, to be honest. Now, interestingly, this move does not benefit anybody, including bears, because a lot of bears have been waiting for the market to actually move up. We've seen that with positioning. In fact, let me show you what I'm talking about. If you look at the put to call ratio, bears have actually been closing their put position. They've not been building those put positions. Yesterday, they've closed a lot of them. And we're seeing more put positions getting closed today as well. So that's interesting. We're still seeing at these levels people buying calls. So that's interesting. Now let's take a quick look at the HYG, the junk bonds. Unfortunately, there is no divergence, right? We made a new low on the HYG as well as the S&P. So this does confirm that the trend is now firmly to the downside. It is going to be a bearish trend, and this close below the 50-day moving average is going to significantly worsen sentiment. This is going to be very bad for market sentiment, so I do not expect really any significant rallies in the market at least into October, right? Let's jump to the seasonality chart again. We always had this massive sell-off towards the end of August, early September in midterm years. We've seen the beginning of that sell-off back here at the top on the 18th, and we're now seeing a continuation of that selling to the downside. What's also interesting is that we also tend to see some counter trend rallies after the sell-off is complete towards the beginning of September, right? We tend to see some counter trend rallies in the first half of September. So we can expect to see some counter trend rallies, just not any meaningful rallies that will change the trend. The trend will continue to be down all the way into late September, even into late October. The trend does not really change until November, December. Bears have now taken full control of the stock market. Expect a lot of choppiness to come in the next couple of months. September and October also tend to see significant increases in volatility, and we are now seeing that. We were actually expecting a gap fill of this at this level, right? For a rally today and for volatility to move down, fill this gap, and then see a massive sell-off on Monday. Unfortunately, no rally, no last supper for the bulls, just misery and pain. Now, also interestingly, guys, this is the TLT, the long-term treasuries. They are actually moving up. So this is very interesting. This is a new development. Usually when the Fed comes out hawkish, we see yields shoot up and treasuries move down. We're not seeing that, right? Let's take a look at the 10-year treasuries. Look at that, no spike to the upside. So this head and shoulders top is possibly still in play. We need to see a close below the green 50-day moving average for this head and shoulders to be confirmed. The 2-year yields, on the other hand, did make a new high today. We wicked through and came back to the bull flag. This remains a bull flag, so we could still see yields move up. But the reason this is very interesting, guys, is that we do not tend to see bonds move up in bear markets until the very late stages of the collapse. So we're now really in the late stages of the collapse. Unfortunately, that means the worst selling is coming in the next couple of months, because these late stages tend to bring the most pain, unfortunately. Let's take a look at the daily chart for the triple Qs. We are now back at the 100-day moving average. We will likely close below that. The Nasdaq is now down 4%. 4%, absolute insanity. I can't even remember the last time we saw the triple Qs down 4%. So very, very significant selling. We can expect a lot of choppiness next week. We do have this support line, this red support line. Watch for a bounce back above this support line and the 50-day moving average. If the Nasdaq closes below this support line, this would indicate that the Nasdaq will likely, very likely, test the lows again at $270. That would be a massive, massive sell-off from the top. That would be a 20% sell-off from the top. Basically a new bear market just in this last leg of selling. So watch for a break below this support line. I'll be watching for a break below the support line. Now let's take a look at the IWM. Again, the bear flag structure is much more pronounced on the IWM as compared to the other indices, primarily because the IWM actually managed to close this gap right here, while the S&P came in short and the triple Qs came in just short of closing that gap. It's also important to point out, guys, that during de-risking phases of selling, just like we're seeing now, small caps tend to be hit the hardest. So watch out if you are an owner of small cap stocks. Make sure to manage risk and possibly hedge your long positions. Now let's take a look at the dollar index. The dollar index held this bull flag. We have not seen a breakout above this bull flag just yet. Now imagine if we see a breakout above this bull flag, how much worse the selling in the equity market is going to get, because we haven't even seen a breakout above the bull flag and we're seeing massive selling in equities. Unfortunately, this just means more pain to come. Let's take a look at Apple. Look at this absolute insane sell-off in Apple. Not only did we take out the 20-day moving average, we're now really a spitting distance away from the bottom of the Bollinger Band and the 125-day moving average. For Apple, guys, the most important pivot zone is going to be at $150, right? Because it acted as support. Once we broke through it, it acted as resistance, and once we broke through that, it acted as support again, where we bounced right off that level. So watch for a pullback at least to $150 on Apple. Let's take a look at Tesla. Unfortunately, we had this bull pennant on Tesla, and I did say in the previous video to watch for a break above or below, and unfortunately we're now breaking below. There's no real support for Tesla beyond this $275 level until all the way down to 250, right? This gap right here. So watch for a fill of this gap at 250. We could see even more selling after that, but for now, watch for a pullback at least to the $250 level. Now let's take a look at oil. Oil continues to flag. We're still seeing this bull flag in oil. This is positive for oil, for energy stocks, for energy equities, including ExxonMobil. Now, interestingly, ExxonMobil is now seeing a double rejection of the $99.9 level. So just below this gap fill level, and we're now seeing a double rejection. I think a pullback to the 9 period day moving average, the 9 EMA, or even the 20 EMA is very likely, very possible. So watch for a pullback. I have not gotten back into my long position on Exxon just yet. I will probably be scaling back in at the 9 EMA and at the 20 daily moving average. I'm still very bullish on Exxon. I think energy will now retake the leadership from tech stocks and cyclicals. We've seen cyclicals and tech really outperform everything else the last couple of months, as we've seen this really enormous bear market rally. The bear market rally has now officially come to an end, thanks to the boogeyman Jay Powell showing up. And so expect on the way down for equities, for energy to outperform everything else, probably even making new highs. Now, if we simply track this channel that Exxon has been trading within over the past several months, smack in the middle of the channel by the end of the year, ExxonMobil will be sitting at $110 all the way to $130. So if energy continues to outperform, and energy will likely continue to outperform, it is reasonable to expect that Exxon could end the year anywhere between $110 to $130. If we see a significant slowing in the economy, especially in the global economy, energy stocks could get hit really hard as well. So do not rule that out. Manage your risk. I like holding a hedge in the S&P. I do hold some September 30th puts on the S&P. They're now up, I think, 40%, probably more than that. They were up 40% at $410, so they're now probably up significantly more than that. It's a small hedge. I've added to that hedge position. I've tripled that hedge position today. I've added another significant large hedge position to protect my AMD long position. And again, guys, if you want to follow my trades, I do post every single trade and investment in real time in the Discord trading community. So if you're interested, check the link in the description. It's 20 bucks a month and you get access to all of my trading activity. It's also the best way to support me if you want to do that. Now let's jump back to fear and greed. Now we're seeing a collapse in greed in the market. This absolute insanity of a sell-off will no doubtly significantly damage sentiment and drive fear in the market. So I expect next week to see us in the fear reading. Again, we're now below the 125 daily moving average. We failed to hold this level. Again, this lends credence to the fact that we are probably still in a bear market. The stock price strength really faltered at the 0%. Again, a hallmark of bear markets. Price breadth continued to collapse, even as we saw that massive bear market rally. Breadth continued to collapse, and this is again one of the hallmarks of bear markets. When you see counter trend rallies with really weak breadth. Put to call ratio, we're now seeing that move down. This will likely move back up. At the close of today, market volatility is now again above the 50-day moving average. This is very bad for equities. Nothing good happens for stocks when volatility is above 25 and above the 50-day moving average. So be very careful, guys. Safe haven demand again is rising. Bonds are now outperforming stocks, and junk bonds are underperforming investment grade bonds. In terms of the economic events that we have coming up next week, we have the Consumer Confidence Index coming in on Tuesday. Wednesday, we have Cleveland Fed President Loretta Mester speaking. Tuesday, we have a bunch of economic figures coming out, including labor costs, more job numbers, and more Fed speak. Friday, we'll have the unemployment rate and more job numbers for labor force participation. So not a lot of major economic news coming up next week. Nothing really to stop this sell-off from continuing to push stocks to the downside. This could significantly accelerate the stock market sell-off, especially as we approach that $390 level. There's nothing really stopping this market from continuing to collapse all the way to $390, where we might see some bullishness come back. and we'll see if bulls manage to take back control. If they fail, we do have this gap all the way at 378 and one final gap at $366. Now, the most likely scenario, in my opinion, is that we will go back to 390, try to rally, attempt to rally, fail, and then have one last flush down to 378, close this gap, and then move back to the upside and create a false break bottom. Now, for this scenario to play out, we need to see the stock market hold 390 for at least a few weeks, and for the PPO, for market momentum, to start flattening at least for a few weeks. And then if we see something like this, where the 390 makes a low on the PPO and the 380 makes a higher low, making a divergence, that would signal a bottom. Without a divergence, I do not think that this false break bottom would be the final bottom. So watch for a divergence on the PPO. That's going to be the biggest hint into the next bottom. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.